For joining us today, and welcome to the International Lawyers Network's webinar on representations and warranties in insurance in cross-border M&A transactions. Just a quick housekeeping note for everybody. As I mentioned earlier, if you have any questions throughout the program, we're going to be holding those until the end. You can use the Q&A box that's at the bottom for those questions. I'll also be monitoring the chat, so if you have any questions that you put in the chat, I'll also keep those until the end, but feel free to use the chat to speak with each other as well throughout the program. And this program will also be recorded, and we'll be sharing that afterwards for you. So if you want to watch it again or share it with your colleagues, you are also welcome to do that. So with that, I will turn it over to our panelists who will introduce themselves. Thank you so much.
Thank you, Lindsay. Thank you all for coming. It's quite a robust attendance, which is great. So good morning, good afternoon, good evening, wherever you are. My name is David Gitlin. I am a corporate partner at RCCB in Philadelphia. I have been a corporate M&A lawyer for over 40 years, logged in about north of 350 M&A deals. About half of them have been cross-border M&A deals, and I have been using rep and warranty insurance on my deals for about 10 years or so. Henning?
Thank you, David. Henning von Lillienskjold from Denmark. I'm an M&A lawyer with DAHL Law Firm. Only been that for half as long as you, David, about 20 years. And done a lot of cross-border. Denmark is a small jurisdiction, so most transactions are actually cross-border. And for the last, I would say 6-7 years, reps and warranties insurance has really picked up in Denmark as well. So I think about a third of it, I would say, is covered by insurers nowadays. Yeah. Over to you, Josh.
Hi, everyone. My name is Joshua Begner. I am a global M&A director at Willis Towers Watson. I'm a lawyer by background. I spent 9 years as a corporate attorney in London at a firm called S.J. Bowen before moving to Wilkie, Farr and Gallagher in the London office. I moved to Marsh, where I spent 2 years as a global M&A director, advising on cross-border transactions across Europe and the US. And then to WTW to set operations in the first Israeli M&A insurance desk, whilst continuing to work on global transactions in the US and Europe.
Great. All right, so I thought we'd start with the basics. What is rep and warranty insurance? So here's the best definition I could come up with. Rep and warranty insurance is insurance obtained by the buyer from a third-party insurer to replace the seller's indemnity for breaches of all or most of the reps and warranties in an M&A agreement. Did I?
That sounds accurate. Yeah.
Okay, good. All right. So let's talk about why getting rep and warranty insurance is a win-win for the parties. How it benefits the buyer, how it benefits the seller. So here are the reasons why it benefits the buyer. Reason number one, it often results in a higher insurance coverage than the coverage the sellers are typically willing to provide. Right. So, for example, in a typical M&A deal, not insured M&A deal, the cap for liability, with some exceptions, fundamental taxes, etc., but the cap for regular breaches of reps and warranties is typically 8 to 10% of the size of the deal. In insurance, the buyer can obtain insurance for a higher threshold, right? So they can go up, to 20%, for example, if they wanted to, essentially double the amount of coverage they get. So that's one benefit. Second benefit is often you have better creditworthiness with the payee, meaning the insurance company, versus the seller. Right? Sometimes the seller is very creditworthy, sometimes it's not, but an insurance company, it will be creditworthy. So you have a better payor to the buyer with insurance coverage. The third benefit is that you have a more expansive scope of the reps and warranties, because on an insured deal, the liability shifts from the seller to the insurance company, and therefore, if you're representing the seller, you really are not. You're going to be more flexible in the kinds of reps and warranties you're going to agree to, because they're not covered by your client, they're covered by the insurance company. Now, the insurance company is going to have its own standards, but usually my experience is that you end up being more flexible with those reps and warranties. And the fourth benefit to the buyer is that the insurance coverage typically will have a longer survival period, longer coverage period. So insurance, my experience is that you get up to 6 years of coverage, whereas a typical survival, would be 18 months, for example. So those are 4 benefits I can come up with. Henning, Josh, did I miss anything, or are those benefits not available?
No,
or different in Europe, for example?
Yeah, I would say from a buyer perspective, it's quite often also if there's reinvestments, you don't want the hassle with the reinvesting sellers. Afterwards, it's much better to go after an insurance company than getting into litigation with your reinvesting sellers. And that actually also goes, even though the founders are not reinvesting, typically you want them around the company to some extent. You probably make an earn out or something to give an incentive to stay on, and then you don't want litigation with your founders as well. So
they become your key employees sometimes.
Yeah.
I think that's right. And when I think about the formation of rep and warranty insurance and really what drove its growth, it was primarily private equity funds who didn't want to be in a position where they had to effectively sue management teams, which wasn't a great way of building a relationship long term going forward. So I think that's right. The other point I would know, and this goes to what you were saying around longer periods of coverage, David, is that buyers have realized that the rep and warranty insurance is a commercial tool that actually, when looked at holistically within the context of the wider transaction, you can use the insurance to put yourself in a better, stronger position commercially as a buyer under the policy, and therefore agree more seller-friendly provisions under the SPA. So if you're in an auction context, for example, insurance can play a key role in giving you the protection you need whilst allowing the seller to remain in a stronger position. So when you think about insurance, the reason I think the growth has been so rapid over the last 5-10 years is because it really benefits both parties. And from a buyer's perspective in particular, you can remove materiality qualifiers, you can remove knowledge qualifiers, you can synthetically amend the wording of the reps, you can synthetically have tax indemnities under your policy instead of having it under SPAs. So you're in a position where, as a buyer, you should really view the insurance as a commercial tool to improve your own position and your commercial position within, in particular, a bidding context.
Correct, which is why, in bidding situations, it's almost required to have insurance, because you're at a very big disadvantage if you're a buyer and you don't have one versus a buyer who has one.
Absolutely.
Because it benefits them and it benefits the seller as well. So how does it benefit the seller? So the obvious thing is, it shifts the recourse from the seller to the insurer, right? That's kind of the obvious benefit. That alone is worth having it. But it also lowers the liability cap of the seller significantly. So, for example, if you have a deal without insurance, and your liability cap is, let's say, 10% of enterprise value with rep and warranty insurance, the liability cap will typically be 50% of the insurance retention. So if you have an insurance retention of 1%, 50% of that will be 0.5%. So you are lowering the cap to the seller from 10% of the enterprise value to 0.5% of the enterprise value. That is a very significant benefit.
100%. And you see increasingly, and certainly when you think about European deals, for example, in Europe, you tend to see lower deductibles than you do in the US typically. So deductibles in Europe, I mean, on a real estate transaction, for example, deductibles have been removed completely. And in the context of an operational target, a business, you're seeing deductibles as low as 0.25, 0.3% in certain jurisdictions in Europe. So when we talk about the 0.5%, even that is dropping and dropping to put the seller in a stronger and stronger situation. And when you think about it from a seller's perspective, here is a solution which is often paid for by the buyer and effectively allows the seller the clean exit that they need to either redistribute their proceeds or to invest elsewhere. There's a very strong, it's a big reason why it's proved so popular among sellers. And it's, as you say, it's actually what we see more and more, in particular in Europe, but you see it in the US as well, is sellers driving the process. So it's very common in Europe, for example, for sellers to be the one to instigate the process, that you actually get terms, rep and warranty terms on the sell side, which then flip across to the buyers at the relevant point in time. So it really, the benefits for the seller are just as strong as they are for the buyer, and that's why it's so much driven by sellers in Europe.
Right. So we'll talk about terms a little later, but it's clear that, at least based on my experience, the American market is more expensive than the European market. You would think it would be the opposite, but it's not. And also in the US, really the buyer drives the process as opposed to the seller. So those are some big differences. All right. So yeah, so my next point was going to be the fact that in the US, the buyer is the one who obtains the insurance and most often pays for it. I mean, there are some deals where they negotiate some reimbursement on the part of the seller, for maybe half the fee or a portion of the fee, but the buyer is the driver of this. Not so in Europe, I guess, in all cases.
Well, I mean, Henning can talk to his experience on deals. What's interesting is that you almost have to split the deal into two. When you think about a competitive auction process, it's a given that the buyer is going to pay for it. When you're talking about a bilateral deal, it may be slightly different. Be interesting to hear from you and Henning, from your experience, whether the last 12, 18 months where we've seen a slowdown in global M&A and therefore less of a seller market and maybe more buyer strength in the market, has there been any pushback in your experiences where buyers on bilateral deals are turning around to sellers and trying to negotiate for cost to be split? Or is it still, are you seeing on most deals that a buyer is paying for it?
I'll still say on most deals, the buyer is paying for it. It also depends a little bit when it comes up, because sometimes it is a buyer demanding a big escrow or something like that, and then all of a sudden the insurance come up. And perhaps if everybody feels that the seller has a big interest in this as well, then quite often it is actually split. And of course, you can always discuss who's actually paying for this. The buyers know that the cost is there, so and they give a bid on the company.
Yes.
So like with the equity bridge or anything else, it's up for negotiation, right? So yeah.
Well,
and it is a known cost, and everybody knows more or less what the price is for this insurance. So
I've actually seen. Yeah, I mean, I've actually seen a couple deals fairly recently in the last 6 months where sellers have been wanting insurance and buyers didn't want to take insurance. And the end result was the buyers did take it, but the sellers actually paid for it. So we are seeing a little bit more flexibility than we were maybe 18 months ago.
Yeah, I had exactly the same experience. Actually, one of the deals that I closed on the first quarter of this year, where the buyer obtained the insurance, the seller was driving it, the buyer obtained it, and they split the fee. Yeah, at the end of the day, and we kind of argue about that a bit because we're not used to splitting. I represent the seller. The buyer was a European buyer. The seller was an American seller. And we're not used to splitting it. But at the end of the day, we felt that, money is fungible, and, if it makes them feel happy for us to contribute a few $100,000 in the other scheme, things that are fine. But that's the experience I had just this year, actually.
And it can also vary a little bit from jurisdiction to jurisdiction. And I would say in the Nordics and the northern part of Europe, we have very good experience with insurance, also with the coverage and actually getting paid. And then perhaps in some other jurisdictions, they're not so happy with the insurance. So the buyers will be more reluctant to take it out, and the sellers will be more keen to actually pay for it to get it anyhow. So, yeah.
It goes to one of the interesting points around who's taking the insurance. Generally, the profile of the insureds. Historically, it was private equity funds really drove this. But increasingly, year by year, we've seen strategics make up more and more of the insured deals that we're doing. So strategic buyers who, for a long time, the feeling was that you saw less insurance by strategics who either would self-insure or just didn't have appetite to be taking these solutions. Certainly in our experience, from our stats, strategics make up well over 45, close to 50% now of the deals that we do. So actually, a lot of the time when you think about if it's a private equity fund buying, it is almost always the case that they will want insurance. Strategics, it isn't necessarily as certain, but more and more strategic buyers are recognizing the value it brings.
We see the same, yeah.
Right. Yeah, and I would say that most of my deals involving strategic buyers have insurance.
It's interesting.
Yeah, only the really small ones don't, but most of them do. All right, so what does rep and warranty insurance cover? So, as its name suggests, it covers breaches of reps and warranties. It doesn't cover breaches of other things, like covenants, right?
Yeah.
You're not going to be able to insure a non-compete covenant. You're insuring breaches of reps and warranties. It covers most or all non-fundamental reps. More and more, it covers more rather than most, but insurance companies have their own guidelines, and they may not cover certain things. And so some things they will tell you in advance, we're not going to cover X, right? And others, they may come back after due diligence and say, well, we're going to cover it, but we're going to exclude the following circumstances that we discovered in due diligence. So that's why I say it covers most of the non-fundamental reps, but often not all of them. It also covers, in some cases, fundamental reps and taxes, which it used to be like 5 years ago or more. I would say it would never cover fundamental and taxes. They were always excluded. But in the last 5 years or so, I find that, for a price, an additional fee, they would cover fundamental reps as well, and taxes, which is really awesome from the perspective, really from both sides' perspectives. Any comment on that? Do you have different experiences?
I would say in the Nordics, fundamental and taxes is always covered, and they're never excluded anymore. So and all of the normal rep and warranties are also covered. Sometimes in tech deals, it takes a lot of due diligence to get the source code and something like that covered. But otherwise, yeah, more or less everything is covered.
Yeah, I think that's right. I can say that when you think about what's covered, the starting point on any transaction nowadays will be that all of your reps, in theory, in principle, should be covered. Your fundamental reps, your tax reps, your business reps, everything should be covered. But when you think about the exclusions that we see, it's the category that we have of market standard exclusions, which more and more between the US and Europe is now really identical. There are a few minor differences, but nothing significant. And those are things like actual knowledge of breaches prior to closing, prior to signing, which the deal team know about, and transfer pricing, certain types of tax credits, losses, things like that, underfunding of pensions, which tend to be general exclusions. But the standard exclusions are getting smaller. And the specific exclusions that you see, as you alluded to, David, will really depend upon the nature of the deal. You know, if you're doing a transaction which has operations in certain geographies, things like anti-bribery and corruption may be more challenging to get covered. But if you're doing certainly a transaction across Western Europe, across the US, you would expect the majority of your reps as a starting point to be covered. That's where we should be.
Right. Right. And it's important to mention that once the reps are covered, a key provision in the coverage is that the insurance will waive subrogation seller except in cases of fraud.
Yeah.
So that's kind of the fundamental provision that everybody should have in the agreement. It says, okay, you're covering it. You can't go back against us, the sellers, in subrogation claims, except to the extent that there's actual fraud, in which case all bets are off.
Yeah, absolutely. I think generally when you think about coverage, it's probably worth just giving some context, I think, for people on the call where we are at the moment. You know, the insurance market, the rep and warranty market, is a really interesting place in that when the global M&A market is not as good, when M&A volume globally is down, insurance terms get better and better. And that's because there is less, the insurers have, if you think generally, there are multiple billions of dollars of insurance capacity across 45, 50 M&A insurers across the US and Europe. A little bit like a fund, those insurers have to be utilizing that capacity. Now, in 2021, when M&A volume is at an all-time high, insurers can pick and choose which deals they're going to do, and their capacity is at a premium. And that means, we'll talk about pricing later, but that means pricing goes up, but it also means coverage becomes more restrictive. They can afford to be more, a little bit more tough when it comes to deciding what they will cover. But in a market like we have now, where M&A volumes are still down globally, there is a huge overflow of capacity, and frankly, not enough M&A at the moment to fill that. And the result of it is increased competitiveness amongst insurers, which is why people may be seeing now on deals that you're doing in the US, in Europe, the terms are really broader than they have ever been, and coverage is broader than it's ever been. And that's because insurers need to find ways of being competitive. And that means dropping a lot of the previous restrictions they may have had, and being a little bit more commercial when they think about what is the risk, what is the exclusion, and does it really apply to this type of business? Is this actually a risk based upon my understanding of the business itself? So things like that are really interesting, but and all of those external factors impact the coverage we see on deals.
Right. Great. So let's go back to the issue of how insurance affects the caps and baskets in a deal. All right. So if you have insurance, typically what happens is, at least in US deal, right? What happens is that you have a retention. Again, it's the retention, you know, it could be really, really low, but let's say, you know, somewhere between, you know, 0.25% to 1% or 1.25% of the deal, depending on the size of the deal, the circumstances, but more or less, right? So the sellers and the buyers typically divide the liability for that retention, such that half of the retention is typically the basket, which means the buyer bears the cost. So that is how the buyer bears the cost of half of the retention. And then the other half is typically the cap, which is how the seller bears the cost of that piece of the retention. So as we explained before, you know, having a cap of half of 1% or half a percent is significantly lower than a cap of 8 or 10%. And on top of that, the cap itself is subject to typical survival periods, as opposed to, you know, more expanded survival periods that an insurance company can provide. When the cap itself, in other words, when 50% of the retention amount is large enough, sometimes that amount goes into an escrow, an indemnity escrow, and then just gets treated like any indemnity escrow. But when the amounts are relatively small, sometimes people don't bother to set up escrows for that. Any feedback on that from European global perspective?
I would say from the Nordics and Northern Europe, it's slightly different. What I more see is that the cap and the basket and the retention and stuff like that is more or less aligned in an insured deal and then a deal that's not insured. And what came first, I don't know. But nowadays it is more or less the same, I would say. What actually happens, I agree with what you started out with saying, David, that the cap, it is going down as well. I think it's more like 15% typically in a Northern European deal. But what often happens is when the buyer gets to pay the premium, they decide that they can go even lower because they want to pay less, and they don't think the risk is that big of actually hitting the cap. So many insured deals, you say see a lower cap actually in what you would otherwise normally agree on. But that's because the buyer is paying the premium.
I think that's right. I mean, from our experience, certainly thinking from a UK perspective and also from a US perspective, we as we kind of alluded to before, in an auction context, what we saw and we continue to see is flat $1 caps, whereby you're able to say to bidders, your only form of recourse is going to be under the policy, and if you can't recover under a policy, that's unfortunate for you, but that's the way it's going to be. And then the drafting on the indemnity provisions becomes pretty straightforward because that's it. But on bilateral deals, we tend to see more hybrid structures. And therefore, and on that, it really does depend on jurisdictions. What's interesting for us is on more emerging market jurisdictions, somewhere like Israel, for example, David, where we both do transactions, but also other emerging markets, it is much more of a hybrid approach. So you tend to see buyers willing to say, we will take insurance, but anything not covered, I want covered under the SPA. So you're still negotiating some kind of indemnity to effectively sit behind the insurance to the extent something is excluded. So it's interesting. We see different structures, but certainly the kind of position of $1 cap flat, I think, given the recent market, we're seeing less of that on non-auction deals, and we're seeing, as you say, retentions being split, sometimes being covered by the buyer.
Yeah, in my recent experience, so I handled a very, very, very large transaction, which was really a European transaction for all intents and purposes. There was very little nexus, U.S. nexus, and sounds weird that I was involved in that, but there are historical reasons why. So the seller was a Swiss seller. The buyer was a London-based private equity firm, and the cap was $1, right? So literally no recourse.
Certainly makes the drafting easier.
On that perspective, if you otherwise look at the large English private equity fund deal forms, they're not easy to negotiate or deal with. But at least on the insurance side, that was a very easy part. But that's, in my opinion, my experience has been the exception, right? In most cases, whether I'm doing US deals or Israeli deals, actually, there is a split, and also there's the concept of covered reps and the concept of what to do with excluded reps, right? So the two tiers essentially of caps, baskets, limitations, etc.
The evolution you talk about there is really interesting, because when I started as a lawyer advising on deals with insurance 8, 9, 10 years ago, the idea of a $1 cap just didn't exist. And if you think about it from first principles, the idea would be that a buyer should be no worse off than they would have been without insurance, that the insurance helps take liability away from the seller. But if something isn't covered, a buyer should still be able to have recourse for that. And then that kind of moved away. And then it got to a point where fundamental reps was still covered under the SPA, but because obviously you wouldn't have a $1 cap for that. And it was unthinkable that you would have no liability for fundamental reps breach. And then that moved away as well, certainly in 2021 on many deals where $1 caps became much more common. So it is, again, it's interesting to see some pullback from the market there towards older trends and away from just the flat $1 cap structure. But that was something which really came over the last few years. Originally, that was not the way it was intended to be.
Right. You know, I remember there was a period of time where people would take the position of, well, yeah, we'll cover it. If it's not covered, it's still your liability, right? Yeah. And ourselves like, don't bother. I mean, what's the point?
Exactly. Yeah.
Yeah. That never went anywhere. None of my deals and had that provision. That provision never survived any of my deals. So let's talk about, to the extent we haven't, because we've covered a lot, you know, again, what are the typical terms of obtaining an insurance? So, and I'm noticing that I'm like, you know, US perspective is a little behind the curve from the European perspective. So I'll tell you what I've been seeing. Premiums are typically in the 2.5 to 3.5% of the covered amount, not the enterprise value. It's important to notice. It's based on the covered amount. So if you have $100 million deal, but you're only insuring $10 million of coverage, is of the $10 million, not of the $100 million, right? So that's what I have seen on my deals recently.
I would say
comments
Northern Europe closer to 1%.
It's
Not as
definitely
expensive.
it's definitely cheaper a year.
Yeah, it's amazing because usually the US market tends to drive prices down, right? And the European market is usually more expensive, but this is completely the reverse, which is fascinating.
A lot of that, I think, and we'll talk more, I guess, about the differences between the US coverage and European, but a lot of that is about the coverage. When you think about the US policy, it is significantly more buyer and insured friendly in the breadth of coverage because of the way it's structured. And I think the US is also considered to be, rightly or wrongly, a more litigious society than some of the European countries. So the result of that. Right? But on pricing, again, it's interesting for us because pricing has dropped significantly across the board. You know, you talk about the pricing you have for the US, David, is bang on where we see it at the moment. It's between 2.5 and 3.5. But when I think back a couple of years ago, it was absolutely normal for a US deal to be priced at 4.5 to 5.5%. There were times in December 2021 in particular where it went up to 6%. Which seems insane, really, when you think about that cost, and it's dropped significantly. It's in the UK and in Western Europe. I mean, it has dropped to sub 1. You now see pricing on operational targets in the UK at around 0.7 or 0.8%, which is much cheaper than the US, certainly.
Oh yeah, I mean, significantly cheaper. Right?
Yeah,
and we talked about the retention already, right? You know. US, my experience has been, you know, between 0.75 and 1% of enterprise value. Then it typically drops after 12 months to maybe 0.5%. Obviously, we've heard that the European market the retentions are lower and sometimes non-existent, I guess.
Yeah. That's right. And I think on retentions as well, as we mentioned, in the US, we are seeing it drop. I can tell you I'm working a transaction now where we see the retention at 0.5 dropping to 0.4 after 12 months. And we're seeing even certain insurers in certain markets offering tipping to nil structures as well, which again, all of that is being driven by the need for insurers to utilize capacity. And you know, as you guys, as both David and Henning you'll know that when you take a good deal to 20 insurers, you will have 20 very good sets of terms. And the question is how they differentiate themselves. The only way for insurers really to do that when pricing has already hit rock bottom is by reducing retentions and trying to improve the terms to be more commercial.
Yeah, and by limiting the exclusions.
Correct.
Yeah.
Correct.
And then you would typically also get an offer from an insurer that has multiple options here, that you can pay a little bit more on the premium and have no retention at all and stuff like that.
Yes.
So.
Yeah, 100%.
Right. So let's talk about what goes on during the due diligence and underwriting process. You know, it's something that lawyers have less visibility on. Obviously, the due diligence part, if you're on the buyer side, you have a lot of visibility because you're providing that information to the insurer and insurance company dealing with the insurer on that and answering tons of questions and trying to limit exclusions. But certainly on the underwriting process itself, we have very little visibility. So, Josh, you want to talk about it, generally?
Sure. And when you think about, for the benefit of everyone on the call, when you think about the rep and warranty process, you've effectively got two stages. Stage one is your marketing stage, which is you approach a broker with your lawyer, you provide some high-level information, and within 2 to 3 days, they can obtain rep and warranty terms and will provide a non-binding indication report summarizing all of those terms for you. So, and that's the first section. As you mentioned, David, the second section is the underwriting stage, and that's where you choose an underwriter and you formally go into underwriting. Now, essentially what insurers are doing here, and there's often a misconception that people assume insurers are doing diligence. It's not quite that way. Insurers are not doing diligence. They will review the DD reports provided to them on a non-reliance basis, and that's an important point, that there is no reliance taken whatsoever. And insurers will raise questions about issues they identify, things that require further information. Now, at that point, you effectively, through your broker, enter into a dialogue between the buyer's lawyers and the insurers, whereby you will provide responses, written or orally, through to the insurer. Insurers may have follow-up questions, and it's essentially a discussion to try and get the insurer comfortable on as much as possible so that coverage is as broad as possible. And the job of the broker here is to advocate for the client. You know, when you think about on the transactions people are working on, the broker should be an extension of the buyer legal team, essentially. Their job is to advocate on behalf of their client to get the best possible coverage. And where there are potential issues, it's to get insurers comfortable with those issues. So just a word on process. The process between the US and Europe will be different. So David, as you'll know, in the US in particular, you will have some high-level questions, underwriting questions will be provided, and you will then discuss those on an underwriting call. Now, there are no written responses. Advisors are not providing any detailed responses in writing to insurers. It is all done on a call, which can last sometimes several hours, and that is how the dialogue takes place. In Europe, it's a little bit different. As Henning, you'll know, in Europe, what we see is things are done via written response. So detailed underwriting questions are provided from the insurer to the buyer. The buyer's lawyers and their financial advisors will input with detailed written responses, which are provided to the insurer. And then an underwriting call will be held just to address any follow-up. So it's a much shorter call, and it's much more just to address any issues which haven't been dealt with via written responses. So that for me is an interesting difference, that when you speak to US lawyers and you suggest to them that they should, US diligence advisors, they should be providing detailed written responses, they're often reluctant to do that because it just isn't market in the US. Whereas conversely in Europe, the idea of doing it all orally on a call is just not something that exists. So that for me is an interesting quirk, but the result of both is that you will be issued a coverage position from the insurer, and they will then put the policy in place at signing. And the last point I would make there is that it's important to note that when you get a coverage position, for you as a client, as a buyer, that isn't the end of the story. It's at that point that there's still a lot of work for the broker to do to try and get the insurer comfortable with any issues. So the point is to keep the dialogue going, and to try and get the insurer comfortable as much as possible, so your coverage is as broad as possible.
Right, and so we talked about the benefits. We didn't talk about the detriments to some extent, which pale in comparison to the benefits, to be fair. But still, I mean, the one negative about having an insured deal is, particularly on the buyer side, you're really running two processes at the same time, right? It's a little, it's more burdensome, more convoluted, because you're negotiating with the sellers on the one hand, and you're negotiating with insurance on the other hand. And you're trying to tie all of that together, and it extends the length, the life of the deal by, maybe a month. But again, my view is at the end of the day, it's certainly worth it, but certainly it's more work from buyer's point of view to have to navigate both the seller and the insurer at the same time.
And what I would, well, it's interesting, because I get, it depends on the structure of the deal, because on a deal where you don't have to start negotiating escrows and indemnity caps with the seller, you obviously save time there. But I think a lot of it, and it's an important point for people to be aware of, people should really think about with the role of their broker on a transaction. I always say that insurance can be to the detriment if it's done badly, and if it isn't run well as a process. It can lengthen the process. It can put the buyer in a situation where they don't have the coverage they need, and they feel very much worse off. And that isn't the way it should be done. When it's done well, it should streamline a process. It should take work away from the buyer and seller. But I would say most of that comes down to the identity of your broker, them having experience of having worked on similar transactions, knowing what the risks are and how to get insurers comfortable. But also it goes to the insurers that you select. It's important, I think, for people to understand that when you appoint an insurer, it shouldn't just be about the terms on paper. You should be liaising with whoever your broker is to understand, what is the experience of the insurer? Have they done deals like this before? What is their claims experience? Are they commercial? Are they quick? And those are all things that your broker should be able to advise on, and using that experience to make sure that you're appointing the right people for your transaction, because that experience is key in determining whether or not it is a smooth process or otherwise.
Yeah, you still are bringing a third party.
No question. Yeah, of course. It's which is why being run the right way is so important.
Right.
My experience in our region is, it doesn't prolong the transactions unless it comes up at a very late stage, because you have a week or two for underwriting. Otherwise, it doesn't prolong. I would say if there's one thing that's detriment to a normal M&A situation, is if you have a target with a lot of subsidiaries in a lot of jurisdictions, you need to diligence all of these subsidiaries. And perhaps if some of them are quite small, you would typically not do due diligence on that. You would take the risk, and the seller would still give reps and warranties on that subsidiary. But I think you can probably comment on that, just but I see that a lot of insurance companies are actually agreeing to do some common sense due diligence from the local lawyer, even though it's other jurisdictions. So.
That's exactly it. We're seeing more and more. Again, it's one of those things where people should make sure, in consult with your broker, that when you go to market, when you start liaising with insurers, the time to ask them to do things is before you've appointed an insurer, because there's competitive tension there. And so actually you want as much certainty as you can. So you should be listing in your submission to insurers all of the jurisdictions where you have operations, so that they can tell you outright before you've appointed them where they require local counsel to be appointed. But the key for us, Henning, is that more and more now we push that if it isn't a material jurisdiction from a revenue perspective or an operations perspective, they should be comfortable with a common sense review. It shouldn't require local counsel unless there are significant employees or significant operations.
So I actually have the exact same experience in one of my recent deals, where, well, the deal I mentioned before, where the seller was an American seller, the buyer was a European buyer. our client had subsidiaries, multiple subsidiaries all over the world. Most of them were rather small. And so at the beginning of the process, I started lining up local counsel in each of those jurisdictions, expecting to have to answer due diligence questions. And turns out that except for one jurisdiction, which was very critical and ended up taking half the amount of time to negotiate the deal, just that piece, the insurance company didn't even bother with the rest. I mean, they did nothing. They excluded some things, some labor issues in this particular jurisdiction, which were minimal, but the level of due diligence they did was very, very small, if at all. And all these people that I lined up to help us on the deal, we didn't end up using them, which is kind of a shame from that perspective. But it was a more streamlined process than I thought. But look, at the end of the day, there's always the last minute things, and there's always like, okay, we're all done, and now we're waiting for the insurance to finish the commitment, the underwriting process, and it's always an extra week or two. But again, overall, the theme here is it's a win-win to get insurance.
I think one thing we haven't touched on, David, is, and then this is also a take for the buyers, is that there are huge differences between the US and continental Europe on disclosure principles and the way deals are structured and done. And if you are a buyer and you're doing a cross-border M&A, you can always get an insurance that follows your own principles. And then it's the same way you're used to doing deals. You don't have to, from my perspective, you don't have to do it the US way. You can get a European insurance company and do it that way.
Yeah.
Listen, I certainly from an American seller point of view, they should really look to Europe. It's better terms.
Well, you often see, it's interesting for us because often I've done a number of deals for US private equity funds buying in Europe, for example. And interesting, Henning, they look at the way we do deals in Europe, and they think it's crazy. I mean, and you can, and in the sense that it's so much more restrictive from the insurance perspective, and just a few principles for you think about the general disclosure of the data room. That's just not something you see on US deals, and therefore there's nothing generally disclosed in the VDR in a US policy, but that's standard in Europe. But the question you get from US buyers is, doesn't that hugely devalue the policy or reduce my ability or the likelihood I'll be able to successfully? And the answer is yes, which is why it is more expensive in the US, because it is a product which is more insured friendly. There are de minimis. You have a de minimis on European policies. There's no de minimis in the US. We use a damages basis of loss in Europe, whereas you'll use an indemnity basis in the US. And these are all things which are more buyer friendly on a US policy. And therefore, what we see a lot of is US buyers saying to us, I'm doing this deal in Europe, but I want it to have a US coverage because that is what is better coverage for me. And therefore, for us, as you say, is absolutely right, Henning. You can always build in what you want to build in. You're not restricted to having to do it the way of the specific jurisdiction that you're in. But you should just be conscious that there are big differences in coverage between Europe and the US.
Right. But the trade-off is less cost and less
cost.
Yeah.
100%, yes.
Yeah. All right. I think we have used our allotted time kind of perfectly, right? We timed it really well. So, Lindsay, you want to invite any questions?
Yes, absolutely. And you do have one already. So Anthony Schatz, one of our members from London, who also wants Josh to know that he is ex-SJ Berwin. He asks, said he's obviously in the UK. So he says the scope of exclusions has been expanding in recent years in UK insured deals. So he wanted to know, is that the same in the US and mainland Europe?
I mean, I can speak certainly from my perspective. You're right, Anthony, they were expanding. We were seeing more exclusions. But in the last 12 months, we've been seeing fewer exclusions given the competitive nature of the market, the lower M&A volume. So we are seeing exclusions fall away and it becoming much fewer than they were previously. So I'll let David speak specifically about the US and Henning about Northern Europe, but certainly on the deals we see, we're seeing more competitive terms than we were previously.
I'm not sure that from my perspective I've seen the better coverage yet, but but I think I follow Anthony that there has been more and more exclusions. But sounds good if it'll go the other way now.
I was going to say we'll have to work together, Henning. We need to speak afterwards.
Right, and I look, we as much as we as many deals as we do, which are a significant number but how many deals we actually get to do in a year, 4 or 5. And everybody has different circumstances, so it's a limited sample for us to really be able to see trends the way Josh see trends, right? Because you're doing,
we do a lot, yeah.
You do a lot, obviously, because everything gets funneled, through you, or through your firm. So obviously you have a much better perspective than whoever does 4 or 5 deals a year.
And much will depend also on the sector. And if you're doing a technology deal, for example, we tend to see far fewer exclusions. A real estate deal, far fewer exclusions. But I've done a number of energy deals recently. Financial institution deals, there you tend to see more exclusions. It's considered to be more high risk, and there's more people are concerned about. So a lot will depend upon the sector of the transaction and the geography as well.
And the geography, right? Every deal is different again.
Absolutely, and it really is. And what's interesting for me as well is that it goes to the broader point. We are seeing more and more geographies now utilizing insurance. So, for example, I've done a number of deals over the last 12 months in South America, in India. Jurisdictions which traditionally insurance was very difficult to obtain, and we now see it regularly. And that really is Israel. David is a good example. We now see a huge amount of insurance on Israeli deals. 4 or 5 years ago, that just didn't exist. And really that's the expansion of the market that has come about as a result of the large amount of capacity that exists.
Yeah.
Great. If anyone has any other questions, please pop those either in the chat or the Q&A. And otherwise, we will let our panelists go. I will send up a follow-up email to everyone who has participated today, along with the recording, but also providing our panelists' contact details. So if you want to reach out to any of them directly with questions or follow-up information, we will allow you to do that. And otherwise, we would really like to thank our panelists and all of our attendees today. Oh, we do have one more question. Oh, just a thank you to everybody. And thank you so much to everyone today. We really appreciate it. And we will be following up with all of you with a recording of today's information. So thank you so much to our panelists and our attendees. And we really appreciate it. Take care, everybody.
Thank you, Lindsay. And good to see you guys.
Thank you, everyone.
Thank you.
All right.
Bye.
Thanks so much, everybody.